Welcome back to Debt-Free Dreams, your go-to channel for financial freedom strategies and all things investing. If you've ever dabbled in the crypto world, you've probably heard the term tokenomics. But what exactly does it mean, and why is it so crucial for crypto investors? In this video, we'll break down what tokenomics is, why it's a game changer for crypto investors, and how you can use this knowledge to make smarter investment decisions. Stick around until the end, where I'll share tools and resources to analyze tokenomics like a pro. Look in the description below for links to the tools I mention. Part 1. What are tokenomics? Tokenomics is a combination of two words, token and economics. It refers to the economic framework that governs a cryptocurrency's ecosystem. Essentially, it's how a cryptocurrency is designed to function, its supply and demand mechanisms, and its overall impact on the market. Tokenomics is the backbone of any crypto project. Whether it's Bitcoin's cap supply or Ethereum's transition to proof of stake, understanding the tokenomics of a project gives you insights into its long-term potential and viability. Part 2. 6 key components of tokenomics. 1. Token supply. The supply of a cryptocurrency is one of its most critical aspects. There are two types to consider. Max supply, the total number of tokens that will ever exist. For instance, Bitcoin's max supply is capped at 21 million. Circulating supply, the number of tokens currently in circulation. A limited supply often creates scarcity, which can drive up value if demand increases. Use tools like Glassnode or CoinStats to track these metrics in real time. 2. Token utility. A token's utility defines its purpose within a project. Is it a governance token, a payment token, or used for staking? For instance, Ethereum's token, ETH, powers its blockchain by paying for gas fees. A strong utility can ensure long-term demand. 3. Token allocation and distribution. How were the tokens distributed? Were there pre-mined tokens given to early investors, founders, or team members? If a small group holds a large percentage of the supply, it could lead to price manipulation. Tools to use. Platforms like TradingView allow you to chart price movements and spot potential manipulation. 4. Inflation or deflation. Some cryptocurrencies are inflationary, meaning new tokens are constantly being added to the supply. Others are deflationary, like Bitcoin, with a limited and decreasing supply over time. Example, Ethereum's recent updates, such as EIP 1559, introduced a deflationary mechanism where ETH is burned during transactions. 5. Token governance. Governance refers to how decisions are made in a crypto project. Many projects use decentralized governance systems where token holders can vote on proposals. 6. Ecosystem growth. A crypto's long-term success often depends on how its ecosystem grows. This includes partnerships, integrations, and adoption by developers. Part 3. 3 reasons why tokenomics matters for crypto investors. 1. Predicting long-term value. Strong tokenomics often indicate a project's potential for long-term success. For example, projects with clear use cases, transparent token allocation, and sustainable inflation models tend to perform better over time. 2. Avoiding scams. Poorly designed tokenomics can be a red flag for rug pulls or pump and dump schemes. If a project's team holds the majority of tokens, it's a sign to be cautious. 3. Maximizing returns. By analyzing tokenomics, you can identify undervalued projects with strong fundamentals. For example, projects that focus on reducing inflation or burning tokens can drive scarcity and increase value over time. Part 4. How to analyze tokenomics like a pro. Here are the steps to analyze a project's tokenomics. 1. Read the white paper. A project's white paper is the first place to look for its tokenomics. It should outline the token's utility, allocation, and distribution. 2. Use analytics tools. Glassnode offers detailed insights into token supply and holder metrics. Use this tool to analyze on-chain data. CoinStats, perfect for tracking token performance and portfolio management. TradingView provides advanced charts to study price movements and market behavior. 3. Track token holders. Use blockchain explorers like Etherscan to check wallet distributions. A project with a diverse holder base is generally less risky than one dominated by whales. 4. Evaluate market trends. Stay updated with news and trends. Platforms like BlockFi can help you manage your investments while earning passive income. Part 5. Examples of strong and weak tokenomics. Strong tokenomics. Bitcoin. Bitcoin's cap supply and decentralized structure make it a benchmark for strong tokenomics. Its scarcity ensures long-term value. Weak tokenomics. High inflation projects. Many projects fail because of unchecked token inflation, diluting value over time. Always check for mechanisms like token burning or cap supply. Now that you understand what tokenomics is and why it matters, it's time to level up your investing game. Use tools like Glassnode, CoinStats, and TradingView to analyze projects before you invest. If you're serious about tracking your crypto profits and simplifying tax season, check out Zen Ledger, Coinly, or TokenTax. Links are in the description below. Make sure to subscribe to Debt-Free Dreams for more insights on crypto, investing, and financial independence. Drop a comment below. Which crypto project do you think has the best tokenomics?